And fellow members of the California Club and guests, we hope you and your family are safe and healthy during this extraordinary time. And welcome to the Investments and Economics Committee meeting for September. We appreciate that you're joining us. My name is Craig Lawson. I'm pleased to be serving as co-chair of this committee along with Jay Barnes. And a special thanks to Natalia for helping us coordinate the program today. We hope to do more of these programs before the end of the year. And maybe we'll be able to get back to an actual lunch meeting format sometime next year. We're hoping for that. We're very fortunate today to have two speakers from Green, Hasson, Janks, and I'm going to turn this over now to Jay Barnes to introduce our speakers. Jay.
Greg, thank you, and Natalia, thank you very much, as Craig said, for making this possible. It's my privilege to introduce our two speakers from Green, Hasson, Janks. David Horwich is, David, you might put up your hand if you want, just to say hello. David Horwich is a recovering investment banker with more than 30 years of experience advising both publicly traded and privately held companies on how to grow, how to seize opportunity, and when the time's right, how to exit themselves in a favorable way for their ownership. His partner, Don Snyder, is head of the quality control department at Green, Hasson, Janks. That means that Don, with more than 30 years of experience in public accounting, chairs that department, which includes audit, accounting, and consulting services to clients in numerous industries, including restaurant, food, beverage, manufacturing, wholesale distribution, nonprofit, and technology. He wears a lot of hats, and he wears them well. So it's I'm very glad they're both here with us. One logistical request we make is that any questions that the audience has, would you please use the chat function on Zoom? And between Craig and I, we're going to moderate the questions coming in so we make sure it's interactive for everybody. Thank you, and I'm going to lead it off, I think, with one question to start, and this will be directed at you, David. Can you give us, just as we get into the presentation, can you give us an overview right now on the current market environment and maybe address micro and macro topics that you think are of interest? Thank you.
Sure. Don, if you could page down a little bit to the first slide.
Be my pleasure.
That's great. Thank you. Jay, it's great to be here with you, and thank you and Craig for the invitation to share some thoughts today. Natalia, thanks for coordinating all the efforts here. For those attending, thank you for taking time out of your busy day to be with Don and me. Painting a big picture, when the shutdown started in the middle of March, there was an immediate shock to the economy with all in-person gatherings put to a halt, and both the fear of the virus and the unknown about the virus, people stayed home. During this initial period of time, which this chart shows as the flattened post-stay-at-home orders, GDP activity dropped between 15 and 30% and leveled off through the middle of May when the easing of these orders began implementation. This chart shows that after the restart, the economy entered a fight phase where certain, but not all, sectors began a rebound in terms of activity. We've seen this in our clientele, which, having survived the shock, we're now considering how best to address the new world. Over 20 million employees lost their jobs during the shock and flattened portion of the cycle. From the nadir in April, nearly 10 million of those lost jobs have returned, concentrating in where the initial losses occurred, principally hospitality, gyms, and travel. As we'll see later, while many of these hospitality jobs have returned, it's been uneven, with some states opening their economy earlier than others. BCG, which sees this fight phase, is lasting through the end of 2021, but with success in various vaccine trials for the virus seeming to come on, it feels like this could come to pass several months earlier than the forecast. Once a vaccine has been more widely distributed and introduced, we expect to see a more normal recovery taking place in the future side of this chart, although some industries and individual companies will need to make permanent adjustments to their business models with consumer behavior and anticipated supply chain changes needing to be baked in. Next chart, Don. Diving in a little bit, the data presented here is through early August. There have been nearly 5 million cases of the virus with 200,000 fatalities. This is a far better progression than earlier models, which had forecast in millions, had been anticipated. GDP is now forecast to experience an 8% decline for the 2020 years, and consensus forecasts are showing between 1.75% and 4.5% increases in 2021. Looking in the middle column, down towards the bottom, we've highlighted with red circles some of the data this fallout shows in consumer spending. Not surprisingly, direct-to-consumer businesses have fared quite well through this period of time. Before the shutdowns, we had been preparing a client that owns an online consumer product business for sale. Through August, the client had enjoyed a 120% year-over-year increase in sales and a dramatic improvement in bottom line performance. In June, we advised them as they engaged an investment banker to take the company from market to market for a majority recap of the business, and they're in the market today. Also highlighted is the devastation that's occurred in the restaurant industry. We'll discuss this later in our conversation. Finally, this slide shows some data about changes going on in retail sales. While much of the retail sector is in a full recovery from the March shocks, retail services on the right-hand side have taken it completely in the shorts, and they're going to struggle to stay afloat until their sectors return to more and more normal operations. These business sectors, every one of them is going to require a substantial business model overhaul and reimagining to promote safe environments that consumers will be willing to return to. We're currently working with 2 restaurant businesses, one of which still has not reopened, where the owners are paralyzed by fear about what to do next. Jay?
I think, Craig, is
Sorry,
that?
I was on mute there.
Yep.
Do you want me to, David, to go through the next question?
Yeah.
Okay, so we've all been mostly sheltered at home since March, and restaurants have been slow to open for indoor seating. Can you give us an update on how the retail grocery markets are performing in the last several months? Which are the ones going up, which are going down within the grocery store industry?
So that would be me. And so, first of all, again, thank you for the California Club having us join the conversation. I really appreciate it. I was just getting a little bit nervous back there if I was just the page turner for David. But now it's a chance for me to actually, I don't have as formal presentation as David, but I'm looking forward to it. So with respect to your question, Craig, I wanted to address, what I'm going to do is I'm going to talk about grocery sales, what I see out there in the grocery stores and the grocery sales, move into e-commerce, and then move into food trends. And for those of you guys that I know that are listening, for some people that at least that know me out there, they know my passion for food and beverage. I run the food and beverage practice at Greenhouse and Janks. But it's interesting to note on this slide is that over the last 5 years, the grocery industry has been up approximately, give or take, 3 to 5% on an annual basis over the last several years. The onset of the pandemic, all of a sudden, everything just kind of skyrocketed, and the grocery industry went up about 30%. It's recently taken a little bit of a downturn, but it's still 12% year over year as of June of 2020. Still a substantial increase over the last several years. And in fact, there was a poll CBS did a poll that indicated, and then this is no surprise to all of us, is that about 70% of all respondents indicated that they still don't, we still, and this includes me, and I'm sure it includes most people out there, we don't feel comfortable to go out to restaurants at this particular time. And even if the stay-at-home restrictions were completely lifted. I was out in Colorado this last weekend, and for the first time since the pandemic, the restaurants in Colorado are actually open inside. And my family and myself were a little bit skittish going out to some of the restaurants. So what alternatives do we have? Well, what we're gonna do is we're gonna just stock up at the grocery stores. And what's interesting to note is just some of the biggest changes in the grocery store industry over the last, or at least over the last several months. And the biggest areas of growth have been, as you can see in the slide, frozen foods are leading the charge on the grocery store, being up almost 40%. And that's followed by the produce industry, or by the produce products, and that's increasing 24%. And the refrigerated foods going up also about 20 to 25%. It's interesting to note that the largest components, the largest categories in the frozen food growth area are frozen food, fruits and vegetables, frozen meats, and that's as a result of everybody trying to hoard all the meats that were in incredible flux over the very beginning of the pandemic, just with the fact that we couldn't get meat out from the Midwest. And we're going to talk about this a little bit later in the presentation. It's just the plant-based alternatives. The meat-based alternatives are up about 40%. And as I mentioned just a couple minutes ago, the refrigerated food area is up about 24%. And we just talked about the plant-based alternative, the plant-based meat alternatives. So with respect to the refrigerated, and everybody will walk down the meat aisles, and you can see next to the meat, you're going to see Beyond Meat, you're going to see Impossible Burgers, you're going to see different brands, and they're all in what I call in the meat section. And with meat being somewhat down, and what's interesting to note is that the meat, the plant-based meats have been up on an average 30%. And that's an incredible increase. And this is over the last several years. It's been up from 2017 to 2019. Plant-based meats have been up roughly about 30%. And meat on an overall basis has only been up about 5%. So you're gonna see an incredible lift on plant-based meat alternatives. And we'll talk about that in a second. Obviously, eggs and cheese going up. What's interesting to note on the refrigerated area is the smallest increase, or I guess the slowest moving categories would be in the entrees. The grab and go, the refrigerated, they're almost non-existent, but they've been down 5%. Yogurts, even though when I say the slowest moving, has still been up, but it hasn't been up very much. It's been up only about 4 or 5%. You hear the term center of the store being bantered about, or shelf-stable departments. Forgetting for a second, toilet paper, cleaning goods, which you know are going to take an incredible lift. You're going to see huge, and we have seen huge increases in baking goods, ingredients, and flours being up about 80%. Seasoning related to your own cooking, your home cooking being up almost 70%. Oil and vinegar being up, vinegar and then different types of ingredients being up about 50%. Anecdotally, we're seeing that in several of our clients. David and I share various ingredients companies, and they're having the best year, assuming that they're not servicing food service. If companies are servicing food service, which is the restaurant industry, they've taken a downturn, which David will talk about. But if it's solely in the retail area or the grocery store chain, you're seeing a real big lift in that particular area. I'm also seeing, and the statistics will bear out, is that wellness bars and protein bars being down right now in the grocery store chains, being down about 25%. And believe it or not, and this is obviously before Halloween, and we don't know what that's going to be like, is that we're seeing a reduction of candy. So all you chocoholics out there, which I know that there are plenty, you're still seeing reduction of candies during the pandemic and as a result for grocery store chains as well. So that's the impact there is on the grocery stores, on the retail area.
So Don, this is Craig again. Many of us have taken advantage of the online grocery shopping programs such as Instacart during this pandemic. It appears this is taking off. And what are you seeing in this industry? And do you think that online shopping is here to stay? And also, if you can, touch on what about the suppliers to this industry, those who are supporting what is a very fast-growing business?
I love Craig and Jay because they're my plants. Obviously, they're psychic.
You just hit mute.
Sorry, that was me.
Okay. Can you hear me now?
Yeah.
Great. I
Yes.
love that Craig and Jay are out there as my plants because there must be psychic to know what my next slides will be. But it is interesting. It is interesting to notice that the e-commerce, there's been an increase for e-commerce. Keep in mind that e-commerce is a small sector of the grocery, of the total amount of grocery store sales, or the total amount of grocery sales. And it approximated, at least before the pandemic, about 2.5% of all US food and beverage purchase of sales up through 2020. All of a sudden, the pandemic hits and it did a hockey stick growth of 4%. And we're sitting here talking about 2% or 4%. It's actually a small number, but when you think, and I've got a slide on that coming up in a second, when you think of the number of people that are actually shopping online, it's not going away, and it's not getting smaller, and it's continuing to go up. And it's, as a matter of fact, it's actually projected to go up to 4% or $38 billion in 2020. And in fact, in COVID and during the lockdown, online shopping surged, as you can see from this slide, is it surged about 40% in 2020. The very beginning of the pandemic, and it somewhat slowed down, but alcohol, it's interesting to note that alcohol, we've had some discussions with some alcohol distributors and some alcohol retailers, that it's just really skyrocketed. Online alcohol sales have gone up almost 500%. And on this next slide, I wanted to touch on, for all of you guys, take a look on the left-hand side, the very first line. In August of 2019, online sales were about 1 million to 1.2 million in sales for August of 2019, only to see that increase go from 1.2 to $7.2 billion in the month of June alone. So it's an incredible increase from 1.2 to 7.2. What's also interesting to note is the number of customers that you're seeing online. 16 million customers in August of 2019, to where June of 2020, it's 45 million customers. And so we're on an average, before the pandemic in August of last year, it was on an average that people were buying online once a month. It's now doubled to twice a month or the frequency of online purchases. And if you look at the next slide, and if you notice the trend, Amazon is obviously the big behemoth. And for those customers, those current Amazon customers that are purchasing product, they're also purchasing grocery online. The interesting thing, that several takeaways that I looked at on this particular slide, is that the amount of Amazon customers purchasing groceries online didn't really change from pre-pandemic or 2019 to 2020. It was still roughly about 60% of the Amazon customers. What's really interesting to note, and Craig, you referred to that, was the Instacart, was the purchasers or the customers on Walmart. With the use of Instacart, Walmart went from 37%, people that were shopping already online at Walmart went from 37% pre-pandemic to 52%. You know, who's to figure that people that were shopping online at Walmart were going to increase that much? And that was the big trend that I took away from online shopping. You also see a big trend on Target that went from 15 to 23% was the next big one. And then Costco was the final one, roughly about a 6 to 7% increase from online shopping before the pandemic. So some of the smaller, what I would not necessarily call the smaller customers or the retail centers, but are the people that were actually shopping online using those areas. And it's really, really taken off. And I don't see that changing. And to answer the second part of your question, Craig, and you know, I welcome the feedback from the audience as well, is those companies that are on the peripheral, that are supplying, whether it's paper products, that are doing the corrugated, the boxes, that are actually doing the logistics, their business has boomed as well. So they've been up by 30, 40% year on year. And that's a big increase. I've got one particular client that's a printer, and they print the boxes on corrugated. And their business has been through the roof because they've been able to take advantage of just everybody going crazy, and everybody, whether they're buying online or whether they're buying at the grocery stores, they just can't keep the product. They couldn't, at least at the very onset. It slowed down some, but they couldn't keep the product online at the same pace as they used to have. So, with respect to some of the biggest categories that we're seeing for online purchases, we're seeing obviously non-fresh goods. We're seeing toiletries, personal care, diapers, obviously. We're seeing frozen foods, breads and baked goods. We're seeing some fresh, and people that have been hesitating before, or who have hesitated before to buy the fresh produce, are now going forward and purchasing roughly about 40% more than they had in the past. Fresh fruits and vegetables, where people like to feel and touch those vegetables, something that they had not done in the past. So those are some of the big online purchases with respect to groceries that we're seeing out there.
Don, it's Jay. May I ask a question?
You bet.
Does the Amazon data include the Whole Foods market data on this graph, or are they two separate pieces of data? And is Amazon really then that much bigger?
They're two separate data, because if you look down on the chart, you can actually see Whole Foods market out there as a separate unit, where they did have an increase, but they were, for the purpose of this, treated separately.
It might be time to ask another question that came in. With respect to the increase in online purchases, especially at Walmart and Target, is there data on the incidence of online fraud purchases or online returns?
You know, that's a great question. I don't know the answer to that as to fraudulent purchases. I know that we're seeing approximately for non-online purchases, we're seeing about a 13 to 18% for our food clients. We're seeing about 13 to 18% returns, but I don't know the answer to online purchases.
And one other follow-up on this, does Trader Joe's fall under the Aldi data?
It should, but Trader Joe's is the great unknown. There's never any public data that's available to Trader Joe's. They've been very tight-lipped. They're everybody's favorite, and nobody really knows much about Trader Joe's. So I would only assume that it is.
So Don, this is Craig Lawson. Moving forward, we're seeing some trends that you've already started to talk about. What are the most influential food trends that you're seeing during this COVID pandemic? And what are in relation to plant-based foods, for example, and beverages, what are the largest components that you see in that area? And how important is taste to consumers of plant-based foods?
So, Craig, that was another psychic question that you had. I have to give you credit for just doing an incredible job moderating this presentation. But I do want to address your last question, and that is taste. It's funny, and we're going to talk about this on plant-based protein. There was a survey that was done that indicated that approximately 70% of the people out there value taste and want their plant-based. Everybody wants the taste of meat. And I'm sorry, but I'm going out of order a little bit. But everybody wants the taste of meat. And 70% of people view taste being super important with respect to plant-based proteins. And not only that, but nobody wants, and people that were specifically answering the survey, they don't want their plant-based tasting like cardboard. So taste is extremely important. The problem is, and it gets people upset, is that they want their plant-based meat to taste exactly like a hamburger, which really upsets people that are vegetarians or vegans. The reason that they're going to plant-based foods or plant-based burgers is not because they want a taste of a burger, but rather they don't like the idea of eating a meat. And so they want something that actually tastes something different and tastes like vegetables. So it is quite interesting on that particular question, but some of the trends that we're seeing, that we are seeing, this is a pretty obvious one, we are seeing the return to home cooking. We're seeing that approximately 80%, almost 90% of the people that have no choice but to turn to more home cooking than they ever have. And the trend indicated that they're not likely to make those changes. I don't see that happening anytime soon. We may see it when the restaurants open and everything's safe and maybe we've got a vaccine. But until that happens, I think that we're going to see more and more people cooking at home and getting more comfortable. And I think people will enjoy it a lot more. I think another trend that I'm seeing is that we're seeing healthy balance, more products that are self-care, they're more well-being, more nutritional. We're seeing, for example, more shots. We're seeing energy shots. We're seeing probiotic gut shots, probiotic ulcers. You're seeing collagen-infused products. We're seeing more functional beverages. We're seeing reduced sugars and carbohydrates. Superfoods that are out there are big trends, whether it's in the kale area and or nuts, another superfoods, more bean products. My favorite product out there is a company called I Love Super Seed, and they're donuts. And I never really thought of donuts being what I call healthy food, but I love Super Seed. If you look that up, they're specialized donuts that are supposed to be healthier for you. The last one I wanted to talk about and spend more time is the explosion of plant-based proteins. I'm going to skip this slide for a second, and I'm not sure whether I'm going to come back to it because of time, but I do want to talk about the explosion of plant-based proteins. Currently, about 50% of all consumers in the United States are carnivores, and about 20% are flexitarians. But what's interesting is that they want to add more plant-based products into their diet. And in fact, in the United States, there was about 20% of those out there, and I'm sure that we can all look at ourselves, that we bought plant-based for the very first time, plant-based products. And what's really interesting is, I don't know what the statistics are in the United States, but there was a survey that I read that in Germany and the UK and through the EU, is that 80% of the consumers who indicated that if they tried plant-based proteins, they're likely to continue to do it after COVID. And with that said, and just the fact that 20 to 25% of US consumers are eating more and more plant-based proteins, the world's 5 largest food companies have gotten more and more involved in plant-based, and some of them have been doing it for a long time. If you look at Kraft kind of led the charge. They acquired Boca back in the early 2000s. Nestle has grown its Sweeter brand. They've launched Awesome Burger. They just recently announced, and I think that was yesterday or the day before, that they moved into an incubator for plant-based. And you could see that same thing with Tyson Foods. They've invested in other plant-based lines. JBS, the world's largest producer of meat. And for the most part, most of the meat producers have moved into plant-based products themselves. But what's interesting to note is that we're talking about plant-based meat, and that's only 2% of all meat retail sales. So it's not a huge amount, but it's growing at such a large clip. Not as many people are talking about milk products, and that accounts for 14% of all retail milk. And so I want to show just a couple last slides before I turn it over. I know David's getting lonely out there. So I'm going to turn it over to David after a couple minutes, but I want to point out just a couple of final slides on the plant-based area. And that
Don,
yes,
it's Jay again. I thought we had a couple of questions come in on chat. If we could answer those now before you segue.
you bet.
Okay, so the first one was an observation on that graph about online sales at Walmart. What's the inverse of that? How much are in-store sales either growing or declining because of online sales at Walmart?
With respect to Walmart itself?
Yes, that's the question.
I can't see very much because I can't imagine that it would be very much because, as I mentioned in the previous slide, online sales are only 2%
Okay.
of the total purchases. And when you're dealing with behemoths like Walmart or Costco, it's just a small number. It's going to grow, but it's not so much.
And the second question that came in has to do with how's the chicken business doing relative to Chinese tariffs and the pandemic? Poultry.
That's an interesting question. I don't know the answer on chicken directly. So that one, I don't know the answer specifically. It's a great question. I'm going to try to find that out, but I don't know the answer to how chickens fit on during the pandemic.
Okay, thank you.
I do know that what industry is faring fantastic is seafood. Seafood, when we don't really talk about seafood, is not, has been, there's meat, there's poultry, and then there's seafood. And the seafood industry has really helped itself and has really increased its level of sales. I don't remember the increase in overall seafood sales from pre and post-pandemic, pre-pandemic where we are now, but I know that volumes on seafood, and it could be up to, I'm guessing probably 20%. We've got a fair amount of seafood clients, and they're up a substantial number, but I don't think I'm off too much by saying that seafood's up somewhere in that vicinity of about 20%.
Thank you.
With respect to, just to put some final touches with respect to plant-based, you can see again, it's went from $3.9 billion to 2000, and this goes up through actual March of 2020, but we don't obviously have all of 2020 data. It went through $5 billion at the end of 2019, and it's still growing. And you can see on the lower chart, whereas we're at $2 billion in plant-based milk, and you can see that plant-based meat is almost at $1 billion of revenues. But as with respect to the amount of growth, you've got the other dairy and the percentage of growth between one year to the next. You've got cheeses and yogurts and other, what I call plant-based dairy or non-dairy, is growing at a clip of almost 20%. Meat is also up there as well, or plant-based meats as well, on the big growth. And then with respect to just the final, and I apologize, David, for taking up most of your time, or some of your time, is you can see the largest component by far and away with respect to plant-based milk is almond milk, almost at 1.3 billion, and it's still growing. It's not growing anywhere near as oat milk, which is all about 60% year on year for oat milk. Almond milk is out there at roughly about 8%, and soy actually is the second largest. But just the knock on soy milk has been down over the last year-on-year sales. And with respect to the largest components of the plant-based meats are, you've got your burgers and the links, and you've got your other alternative meats, whether it's chicken tenders, and that's something that's really moving in, sausages that are moving in to being in play. So you're seeing, when it's all in, we talked about taste. Some of the big brands that if you don't know about are brands that you should in fact know about. Beyond Meat just moved in, as I mentioned here, moved into 3,200 retail locations at, I believe that it was at Walmart or Costco. They moved in yesterday, like 3,200. I think it was Walmart yesterday, or just recently. Impossible Burger is obviously a big play. There's Boca. There's Follow Your Heart, which is a vegan cheese company. They are also a vegan cheese. Gardein, Upton's, Life. There's Light Life, Morningstar, and Malk, which is, we talked about oat milk, and there's some of the up and comers from that. So with that said, I will turn it over to the moderators for David's portion.
Are we gonna move to the next page, slide 19?
Yep.
There. So maybe David, if this is your section, I was going to start off with a question, because I noticed on a prior slide there was mention that about 24% of consumers were eating or are eating pre-prepared meals at home. I'd like to know sort of your take on what that means, maybe even how sustainable that trend might be. And obviously, if there's more in-home dining, there's less restaurant dining. And it might be helpful if you could just address sort of those issues and challenges for the restaurant industry. Thank you.
Thanks, Jay. So as Don showed earlier, there's been a significant improvement in eating at home with online business doing very well during the downturn. In the food sector, the meal kit industry had not proven to be a sustainable business model through 2019, but it is now enjoying some bit of a resurgence. Customers have decided the services are worth another look since they were at home and looking for ways of cooking novel and interesting things other than what they make by themselves. Proved serendipitous for Blue Apron, which had experienced substantial declines in new customer acquisition and subscription stickiness, and had begun an overhaul of its operation and business model and the entire value proposition it was offering to customers. And so, as you can see, in Q1 in 2020, as the pandemic's the shutdowns from the pandemic hit, their customer count almost doubled in that quarter, and that continued in Q2. Unfortunately for them and other players in the space, well-heeled QSRs, the ones that were listed here, and independent restaurants have entered this business. They like this market. They're preparing meal kits for people to cook at home or heat up at home. They've sensed an opportunity to provide customers with their popular fare that they can take and make at home, rather than just take out where it gets cold on the way home. Interestingly, grocery stores have also joined the fun and are offering their own meal kits, as well as some of these other popular providers offering. So it's a real confluence of things. The challenge here is going to be for the meal kit niche is, what's the market look like for these guys post-pandemic and a return to something resembling normality? As we'll talk about a little bit in the next slide, restaurants will certainly make some sort of a comeback, and that will cut into eating at home. And so the question on anybody who's investing in the sector is, how sticky is it? Are the sales? And if not, are they going to return to pre-pandemic behavior? So far, initial anecdotal evidence that we're seeing is providing a potentially grim foretelling here. Next slide, Don. For restaurants, we'd all gotten used to spending 50% of our monthly food budget on eating out, whether it be QSRs, quick serve dining, or fine dining, or all the stops in between, with a belief that the virus could be transmitted easily in a food service settings. In the initial onset of the pandemic, restaurant business sales fell by nearly 3/4, which is devastating. During the darkest days in March and April, restaurants turned to off-premise dining experiences. For some cuisines, like Chinese or Mexican food, that transports pretty well. And for those restaurants serving that space, there was not much drop-off. However, fine dining meals don't transport as well. And the recovery there has been at best uneven, and at worst has made a bad situation really, really grim. There's a lot of experimentation that's going on, as most professional restaurant investors are now betting on some component. As much as 30% is some of the conversations we've had with our PE restaurant investor friends to be off-premise dining. So it's going to be a permanent addition to the dining scene. And how restaurants address that and how it travels is really going to be pretty key. I sense that simple is going to be the new norm for off-premise dining. So roast chicken or simple steak or that kind of thing with simple garnishments and vegetables. As the total lockdowns have given way to many state and local governments allowing outside dining, many establishments are reopened with sidewalk, street, and parking lot dining. But you got the same problem as above. Fine diners don't want to pay for an experience eating on the sidewalk on a major thoroughfare. Think about having breakfast or lunch on Wilshire Boulevard or Pico Boulevard and all the traffic going by, and you're trying to eat your breakfast and have a conversation. It's just a challenge. It's not the same kind of experience. And customers are just simply not going to pay up for that. And eating in a dressed up parking lot has led to spotty outcomes. For those restaurants that already had quality outside space, it has been a challenge to get a reservation at those establishments. By mid-September, sales of the industry had recovered to being only down a third. However, interestingly, spikes have occurred over long holiday weekends to pre-pandemic levels of dining. So I guess when a long weekend comes, people don't want to hang out with each other at home. They want to meet friends or whatever it is and get out to dining. And it's pretty similar. 8 million jobs were lost in the restaurant business at the outset. 2/3 of total unemployment in the industry. Some of these jobs were the first to return when openings were allowed, but every restaurant owner is also not just looking to change their business model, but seeking ways to permanently reduce their overhead. So employment is unlikely to make full recovery in the sector. It's pretty ugly out there. 4 in 10 stores have closed permanently, even if outdoor dining is allowed until there's a vaccine. Will customers be comfortable eating indoors? That's a real question. And with the weather turning cooler as we head into winter, the fate of the industry really is on the line here, especially if a management business is relying on outside dining to skate through here. It's likely that a separate stimulus package for the restaurant sector is going to be required to provide sufficient liquidity to return to a more comfortable dining experience.
So David, it's Craig here. I'll get to, there's a couple of questions pending, but I wanted to ask about transactions in the food and beverage industry. What are you seeing as some of the largest M&A transactions in the last couple of years? How do you see this sector performing in the short term? And what are the multiples that you're seeing in the food industry?
Thank you, Craig. So uncertainty is a deal killer for buyers. And so when the shutdowns occurred in March, all deal activity, both M&A and capital markets, ground completely to a halt as financial buyers both weighed the unforecastable environment and turned inwardly to attend to the needs of their portfolio companies. As an entirety, strategic buyers shut down all of their M&A activity and to attend to the needs of their business. We've been working with several companies that were in market with strategic buyers at the table, and only just in the last week or two have we seen some of those deals reignite and some of that business coming back. Transactions that closed just prior to the shutdowns have had renegotiations opened up with clawbacks or introduction of enhanced indemnity claims. For sellers, it's been very unpleasant and very uncomfortable in the early stages of the shutdowns. However, since mid-May, markets began to open slowly back up. Deals are getting done. There's significant amount of capital sitting on the sidelines looking for good homes. With regulated banks also inwardly focused, Debt pricing for deals with leverage has increased with as non-regulated lenders are stepping into the vacuum. So while we think that could have an impact on valuations, we're so far seeing valuations, particularly for food and bev businesses, generally holding up with transactions in certain sectors such as food service distribution or manufacturers of ingredients or products that are going into food service, either not getting done at any valuation or having challenges getting done. It's just not a good time for them. Moreover, equity investors, PE investors are having to take lower overall projected returns on capital because with the banks stepping back and the non-regulated lenders stepping in at higher pricing, larger equity checks as a percentage of total transaction value are getting written than they were before. We're hearing a lot of talk in terms of structure. We're hearing a lot of talk about earnouts, bridging gaps in any valuation thinking between buyers and sellers. Those structures are going to be very, very complex. We don't believe that earnout structures are going to be cliffs where not achieving a forecast is an all or nothing proposition, but rather a continuum of points on a forecast with several scenarios. And that would encourage sellers to really look at forecasts with their investment bankers and other advisors at creating forecasts that take a number of scenarios into account with the possibility that some earnouts may have to be negotiated. Deal activity stepped up the pace in the May and June timeframe, with investment banking firms reporting they're very actively engaged with many clients that are motivated by tax considerations from a potential Biden presidency. For those that aren't aware, capital gains tax rates under Biden presidency has been proposed to essentially double. Ingredients, plant-based businesses, better for you, comfort foods are enjoying premium valuations through well-run processes. Don, the next slide. Turning our attention to the activity, the number of deals closed this year through September 15th in the food sector, we're on the next slide, Don, is identical to this time last year. For those transactions for which data is available, average deal size is twice what it was last year, but the data is a little misleading. It's skewed upwards by multi-billion-dollar deals. The largest deals that have gotten done over the last 9 months were the sale of Rockstar and the sale of Nestle's ice cream business when they were traded. In terms of valuation, average EBITDA multiples are down about 5% year over year through September 15, but revenue multiples were up over 20%. However, that data too is misleading. If you remove the under $10 million transactions from an analysis of that data, while EBITDA multiples held steady with the remaining group, revenue multiples were down 20%. So you went from positive 20 down to negative 20, removing the $10 million valuation companies. That suggests that smaller, high-growth companies, again, think plant-based, better for you, comfort food, were being paid outsized multiples for the anticipated growth. These companies might not even have been profitable, which would certainly explain the lack of movement in the EBITDA valuation metrics. So Jay and Craig, that's it.
So for our listeners, we're right at about 1 o'clock. We're going to keep going for about 15 minutes to answer questions and to conclude. And if you do have questions, please put them in on the chat function. There was one question that came in and it should be for Don. Obviously, we just heard from David in his discussion about mergers and acquisitions and other things. The benefit of having David, who has an investment banking background, as a senior member of your firm, which is an accounting firm.
You can obviously see David's expertise come to the forefront of this conversation, and it's always nice to have David. David joined our firm about 5 years ago.
4 years. 4 years.
Years ago. David was our first non-CPA, and not only was he our first non-CPA, but David will say he's our recovering investment banker. And just imagine the advantage that we have and just the step up that we have bringing David into a client. We know debits and credits, we knew business, and our firm knows business strategies, but to have David come in, be able to handhold a client through an eventual exit just is worth its weight in gold. Whether they're looking for an exit tomorrow or whether they're looking for an exit 4 years from now, David knows the marketplace, he knows the multiples, he helps negotiate with investment bank, with the company in selecting investment bankers, and really walks through the client through the whole investment banking process because he's been there for so long. It was the best hire and the best acquisition that we brought David in that we can ever imagine. It was just the best partnership that we could ever have, is just to bring David in on that type of situation. And it goes beyond just companies that are looking for an exit. David spends a lot of his time working on growth strategies, and whether your companies are never looking for an exit, it's just helping companies grow from one level to the next. He just adds a tool in our toolbox that we never had before.
Checks in the mail.
You bet.
There was also a question in the chat box. There was an observation made about some restaurant companies that look to be doing things exceptionally well. I think the gist of the question is, are those the kinds of companies that one should invest in if they're publicly traded?
I think that's a question for me, or at least I'll take the lead on this, and Don, chime in, please. But I'd be skeptical about investing in restaurants right now. I think there's so much uncertainty. Is there going to be another set of shutdowns, either state by state or federally? I'd be a skeptic, and I think to the extent that valuations, I think to a large extent, valuations have already been priced in. I don't see much upside, and I see a whole lot more potential downside. As I mentioned before, privately held businesses that are trading in the restaurant space, whether it be distribution business or suppliers to the restaurant business, those transactions are for the most part on hold and very challenging to get done. And I think that's as private equity investors are taking a look at those businesses and saying, I think I want to wait for more information.
I would agree, but it's interesting to note how well quick serve restaurants are doing. They've been doing extremely well over at least the pandemic, and how well they'll be able to perform in the future. It just depends on their management, but they're just doing gangbusters right now.
Thank you.
So I think there was one other question in the chat room, which was, do we have an insight into the future of workplace food consumption? I guess with people many people not going to the office, there's probably not a lot of food that's being ordered, certainly in Century City and other places. So the question is about workplace food consumption.
Look, I think workplace food consumption is probably in the same category as building ownership and landlord management. There's a permanent change coming to how people work. We don't know what it's going to be. I'm not sure I'd want to be a commercial office building owner or a lender to commercial office buildings. And so I think that plays itself all the way through to workplace food consumption.
I had a quick question. We're working with some firms that are involved in the logistics business. They're trying to get space that is closer to their customers because they are delivering fresh food and other products that they have to be within a mile or 2 miles of where they're bringing that food. Are you seeing a lot of growth in that business of the what's called the last mile logistics? I don't know if that's Don or David.
This may be a combination, but I haven't seen any large companies moving into that particular space at all. I don't know if there's a great future in it. I don't really have a strong feel on that. I don't know if you do.
I don't have a sense of that. Logistics businesses in general have done reasonably well through the pandemic, moving stuff long distances. But last mile movement, again, I think that goes back to restaurants. How are restaurants going to do here? Some, as Don mentioned, QSRs are doing better than the rest, but everybody's still down. But if it's last mile to a home, that's something different. I mean, Amazon has absolutely killed it during the pandemic.
And the other thing is there's something called ghost kitchens or cloud kitchens. We're seeing some of this where these restaurants are using kitchens that are not on the premises. They're using kitchens that are closer to where some of their customers are. I know that Cantor's has been doing this for a while, and there's others that are looking at this. Do you have any comment on that?
I think they're absolutely killing it. I think that they're doing extremely well. There's been a lot of articles that have been written in recently on how well that they're doing. I think that, and this is even before the pandemic, is that the cost of real estate and just the takeout business, it's an incredible opportunity for companies to be able to go off premise and just have special kitchens just to be able to produce the food and then just do the deliveries without having a formal front of the restaurant. So I think they're doing extremely well. Now, how well that works for the long run, I don't really know, but I know that they're doing well right now.
I share Don's enthusiasm. I think there was direction in that, a movement in that direction, and I think the pandemic has accelerated it. It just makes it easier logistically for all parties involved. The restaurant doesn't take up valuable footage in their own shop, and the delivery companies, have a central place to go for a lot of places they're delivering from.
I was going to ask a question of either of you guys. Do you, in your client base, do you notice anybody thinking about the next 5 years of the impact on institutional food service? And I'm getting there because college might not be the same experience on campus as it used to be. Elementary school and middle school and high school certainly aren't. There'll be other changes like that. So I wonder if anyone you know of is thinking about how to benefit from what might be permanent changes like that.
If companies are not thinking about the future 5 years. They need to be thinking about the future of 5 years right now. I agree with you. I don't know how long the institutional, I don't know how long the impact will be on institutional type food service. I do have several clients that do have clients in that particular area. And what they're trying to do is they are trying to maximize their other revenue areas so that when it does open up, they can move back into institutional sales, but they're trying to take advantage of different sales channels that they already have. But there's no doubt that it's been adversely affected. And so they're trying to fill the gaps right now. They're hoping that it's temporary, but temporary may mean 2 years.
Directly to that point, Jay, I spoke yesterday with an investment banker who specializes in the food and beverage space, and they had a fully valued multiple on the table for a client they were selling that was an institutional food service distributor up in the Bay Area, particularly to workplaces and to schools. And that deal, not only has that deal collapsed, but we're being introduced because there is a growing belief that they're going to need to completely reimagine that business and how they go to market and what their customer set is going to look like, and the strategy to be able to address what is a very large sea change.
So if there's any other questions, please put them on the chat. I did